Maneesh, okay, let's talk about the distribution curve of outcomes here. How close to the center is a breach of the debt ceiling?
So I think we still think it is a tail event. I think we have been here certainly in the past, and then in the past we have had at the last minute things sort of get resolved. So that still is our base case, but I think the key view is that compared to the previous episodes or the last 5, 6 years or 10 years or so, this is probably, just given where the partisanship is, that is probably the the highest possibility of something going wrong.
If you look at what the S&P has done in the last few days, if this loss holds, it'll be the 5th consecutive 1% plus 1% move for the S&P. We haven't seen that in a really long time. How do you play this kind of move when you have this uncertainty with the debt ceiling that necessarily hasn't been priced in yet?
So I think the part of the problem is, as you rightly said, I think even earlier, there are lots of different factors affecting the market, right? So all of these, we would view it as tail events, but we talked about the debt ceiling. There is obviously what's happening in China with the Evergrande situation and the broader, decrease in credit that's happening there. There is also the increase in oil prices, which has again raised the prospect of a stagflation kind of scenario that has been brought to the front. Now, all these three things are in some sense, again, tail events. We'd not expect them to really be the baseline, but that has sort of, the confluence of those things have happened. Now, going to the debt ceiling particularly, we do have an event. All those other things are likely to play out over some time. But for the debt ceiling, we have December 18th as sort of a hard date out there. And when we say it is not priced in, there does not, there's no excess volatility around that event being priced by the option market, as opposed to, let's say, when we're back in the election. Around the election, there was a significant bump in excess volatility. So that is not there right now.
Maneesh, how precise do you have to be? You talk about it being a hard event. There seems to be a series of dates out there that are kind of plus or minus around the 18th. And the government would likely be able to kind of divert funds from one place to another to make sure potentially payments are made. How precise do you need to be in terms of hedging this as an event?
No, that's a great point. So yeah, so December 18th, by December 18th, I meant didn't mean the specific time, but just around a few weeks or maybe a month around that. But even if you look at that period, there is, the vol curve or the option market is pretty smooth. There is no excess bump around that time.
Maneesh, when we're dealing with that part that has like a hard out, maybe, we're also looking at energy prices that are bananas. I mean, the moves that we've seen in natural gas should not be happening in this kind of market. Are you playing that right now?
So we don't have anything specific to recommend on that front, but certainly, the concept that this inflation that is expected to be transitory, again, which is our baseline case, the tail risk is that it doesn't prove to be transitory. And certainly one channel through which that can happen is higher oil prices. So the way we are asking investors to play it is that we have constructed sort of these baskets of stocks, which are more exposed to inflation or to real rates, depending on what your view is. And you can express a view on either of these variables via those long-short baskets.
Just more broadly, puts still look seriously expensive. How do I hedge? What's the best? If you look at all the risks out there at the moment, and I appreciate some of those are tail risks and some of those are not particularly precise in terms of when they pop up on the calendar, but nevertheless, puts still look expensive. If I want to hedge the downside in equities, how am I doing it?
So what you have to do then is become a little bit creative, and that's a great point, right? Just buying puts is too expensive right now, and I think the key thing is also that puts are expensive because investors have bought a lot of protection already. So that will limit the downside in any case. So one way to play this is to do put spreads, or what we're recommending in our latest report is call spreads on the VIX. So that way you're playing for the fact that any sell-off is not going to spiral out of control, and you are selling the more expensive downside strikes or the higher strikes in the VIX, and that can help you decrease your overall cost. Or you can be more creative and do relative value trades, right? So, for example, you can buy puts in S&P but sell downside, sell calls on the rates or things like that.